deemed as safe. Over 90 regulatory bodies across countries around the world, including the FDA and the European Food Safety Authorities, have all concluded that it's safe. And even the WHO itself has said that aspartame is safe as an ingredient. So, you know, I do believe that, in fact, this is not going to be a significant issue with consumers based on just, you know, the preponderance of evidence that suggests aspartame is safe.
Hugh, why even bother with it? I mean, you've kicked it out of most of your products, right? I think Starry contains aspartame, but it's not in Diet Pepsi or any of the main products. Why include it at all if everybody suspects that it's unhealthy?
Yeah, it's a relatively small ingredient in some other sweetener packages as well. But again, relatively small. The amount of consumption on this is a tiny amount. So as I said, I don't think consumers are really going to lock onto this one as a significant concern, just based on the amount of time it's been out there and the fact that it has been declared safe by so many different bodies.
All right. Hugh, great to have you on the program, especially on a day when you're raising your estimates and your forward guidance. Thanks so much for coming to us from PepsiCo. Hugh Johnson is the Chief Financial Officer. Coming up, we're seeing a turning point in the U.S. office space rebound. Well, we're seeing a turning point in the drop in U.S. office space values. Maybe a little bit of a rebound here. We'll talk about it next. This is Bloomberg.
IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on a size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg Markets. I'm John Open with Matt Miller. Time now for today's For What It's Worth. How about 7.7%? That's how much leasing activity rose in the second quarter compared to the first quarter. While the office market has been battered, the leasing gains are a welcome sign for the sector. Matt, in Texas, for example, we've seen some notable gains there in the energy sector. And even if you think about the technology sector, they are subleasing, according to the Bloomberg story on this today, less. So obviously they've been trying to get rid of some of their space, but maybe some trends for a hard-hit sector.
Yeah, well, we're going to need more space for servers if we all continue to use AI or at the same pace as we are now. I have a great chart that shows shows that there actually was a little bit of a rebound in the office space sector in 2022. It then came back down in 2023, and of course, it's the big worry. This is the next shoe to drop. People are all worried about regional banks, but you can see in the last bar that it's just come up a little bit, and now you may see a turnaround in the downward trend for 2023. At least that's the hope, this research by JLL. For John Ehrlichman, I'm Matt Miller. As we continue to watch this market rally, S&P 4,500, this is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Stocks get bought for a fourth day, the dollar gets sold for a fifth, and the VIX crawls back into its hole. Live from Studio 2 at Bloomberg World Headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S., and we're looking at another up day in markets. We got some cooler than expected PPI to go along with yesterday's CPI print. You can see the S&P 500 rising about 0.6%. Once again, it's big tech leading the gains. The NASDAQ 100 up by 1.4%. That's paired with pretty big rally in the Treasury space. Once again, you're looking at two-year Treasury yields down by 13 basis points. That is more so than what we're seeing further out the curve. And as a result, if you take a look at that 2s10s curve, still deeply inverted, Romaine, but we're looking at about 85 basis points of inversion versus over 100 like we saw a couple of weeks ago.
Yeah, keep an eye on the dollar, Katie. It's actually been a big catalyst for this equity rally, if you can believe it. 30 of the 31 major currencies tracked by Bloomberg outpacing the the dollar on the day and on the week. Anticipation out there that cooler inflation will actually indeed cool the Fed. Also, keep an eye on what's going on in the crypto space. A modest rally in Bitcoin today, but a mega rally in Coinbase. A federal judge just a few hours ago ruling that the Ripple Labs token is a security only when it's sold to institutional investors, but not individuals. A potential roadmap there for crypto regulation. A conversation coming up this hour with former CFTC Chair Tim Massett, who now heads the Digital Assets Policy Project at Georgetown and then is an advisor to PayPal on crypto issues. But let's start right now with the big picture. A normalization in global supply chains, a stabilization in commodity prices, and a broad shift in consumer spending, all tamping down producer price inflation. A second day of encouraging price data that has folks like Ed Yardeni talking about the path to immaculate disinflation.
You know, we could have a trifecta of really great numbers. Expected inflation on Monday was lower than expected, and the CPI was great, and I think the PPI is going to be very good as well. So disinflation is here.
Ed Yardeni there, Katie, and he's not the only one now talking about disinflation being a tailwind for this market.
And I don't know if this chart behind me is immaculate, but it looks pretty good, especially if you're a Fed policymaker. If you take a look at what the CPI breakdown yesterday that we saw was, almost every component showed signs of progress. And if you pay attention to the yellow line, that is your core number falling below 5% on an annualized basis. And that red line, that is your headline CPI. We're back at 3%. It feels like a long time since we were last there. It's not 2%, but it is amazing progress when you think about the fact that we were over 9% just a year ago. And if you look at what that's meant for markets, it's meant a big rally in the stock market, and it's also meant that volatility has continued to grind lower. You're looking at the VIX here versus the CPI headline year-over-year number, and as you can see, the VIX has just been grinding lower and lower. Right now, remain below 14, looking at 13.5 on the VIX.
All right, let's get straight to Liz Ann Saunders, our first guest here to help kick us off to the close, Managing Director and Chief Investment Strategist over at Charles Schwab. Liz Ann, let's start off with the inflation numbers. The last 2 days, encouraging. I don't think you can nitpick too much out of these reports here. I guess the question is, what is the actual second-order effect here for the markets? Are we getting maybe a little too optimistic?
Yeah, the one thing I worry about right now is sentiment backdrop. You know, we've been saying that to feel confident in the rally persisting, you would like to see a bit of a broadening out, which we did, and I think that's good news. But the little bit of a correction that we got up the cap spectrum to ease some of that concentration problem that had really developed heading into June didn't do much to dent confidence across both behavioral and attitudinal sentiment indicators. Now, sentiment can get stretched and euphoric, frothy, whatever term you want to use, and stay there for a while. We all learned that in the late 1990s, but all else equal, I think that represents a bit of a risk. The other thing specific to the inflation we have to remember that base effects were really flattering in this June release because it was June last year that it was, you know, off the charts.
Hey,
so,
Liz Ann, I just need to interrupt you for a second. My apologies. We do have some breaking news here. Learning that St. Louis Fed President Jim Bullard is said to be stepping down as head of the St. Louis Federal Reserve. That would take effect on August 14th, according to Bloomberg reporting. We're learning that Bullard is going to take a position to head Purdue's business school here. Once again, the headline, and we don't have a lot of details here right now, but St. Louis Fed President Jim Bullard said to be resigning as soon as August 14th to take over as the head of Purdue's business school. Katie, this is a pretty interesting development here. I'm not sure that this was expected. Of course, he has been around for quite some time, and of course, we know, of course, leading up to this whole rate tightening cycle, he, of course, has been one of the more vocal members of the Federal Reserve Board in terms of what he felt is the direction of rate policy.
That's the thing, and that's why this is so surprising. Jim Bullard, of course, one of the most vocal Fed members, as you say, and this is happening pretty quickly. We have about a month's notice here. What this means for the future Fed path, of course, is up in the air here. It'll be interesting to see who is going to succeed him, but some definitely interesting news out of the Fed, unexpected.
Yeah, certainly unexpected here, and it'll be interesting to see how this changes, not just the complexion of the Fed, but really the debate going on. Of course, we've had quite a few changes in the makeup of the Federal Reserve over the last year and a half or so here, and this now will add a new wrinkle there, as we'll have to find out who, of course, will lead the St. Louis Fed. Bullard, of course, who has been very prolific in his public comments as well here on Bloomberg Television, has never really shied away from making it known where he thinks rates should go, and of course some of his disagreements with some of the policy prescriptions that Jay Powell himself has sort of pushed forward. Once again, just to reiterate the headline, we are learning that St. Louis Fed President Jim Bullard does plan to resign from the Federal Reserve to take over the Purdue Business School here. Some conflicting headlines we should point out about exactly the date that he will be stepping down, but nevertheless, the headline here that Jim Bullard no longer will be heading up the St. Louis Federal Reserve. Kathleen Hayes standing by right now, who covers the Fed and of course has interviewed and sat down with Jim Bullard countless times over the years here. Kathleen, this is a shocker to me. Is it a shocker to you?
Shocker to me indeed. And as a matter of fact, when Jim Bullard took over from Bill Poole at the St. Louis Fed, how many years ago? You guys can catch me up on the details. I did his first television interview with him. And I remember sitting down with Jim, and he'd been there for a long time. He was the director of research, I think, when he took over. And I remember saying to him, we were talking a little, you know, when you make a small talk with someone before the interview starts? And he said to me, as he was there, he goes, you know, and he meant it. He said, I don't really know why you want to talk to me. And I said, Jim, you'll understand why. And of course, over the years, Jim has been a thought leader. For example, I remember doing a radio interview with him a couple years after, I think, when he took over. And at the time, the Fed had just done the first round of quantitative easing. And he was the first person on the Fed I ever heard say, right after it started, you know, we're going to have to talk about the parameters for quantitative easing, what determines when we do it, how we do it, in case we have to do it again.
So just to reiterate here for our viewers, we are learning that St. Louis Fed President Jim Bullard is planning to step down. And as Kathleen alluded to, he has been there for quite some time, taking over officially as head of the St. Louis Federal Reserve back in 2008. But of course, he started his career with the Federal Reserve Bank of St. Louis all the way back, I think, in the early 90s here, went into academia and then made his way back to the Fed and the FOMC. And now learning, Katie Greifeld, that he will step down at least as soon as August 14th to take over the Purdue Business School.
And reading the press release, we do have a quote from Jim Bullard. He writes, "It has been both a privilege and an honor to be part of the St. Louis Fed for the last 33 years, including serving as its president for the last 15 years. So, Kathleen, obviously quite a tenure there. Talk a little bit about the role that Bullard has occupied at the FOMC.
Thought leader.
Yeah.
He was, take a look at this, this last 3 years, right? Coming out of the pandemic, Jim was one of the first people who made it clear that the Fed was going to have to get much more aggressive. He was the one of the first to start talking about needing to front load interest rate hikes. There was a time after 2008, where I think it was around 2015 or 2016, where Jim and Chris Waller, now Board of Governors, right, for the last couple of years, he was Jim's director of research. He was also his graduate school professor. Anyway, they put out this piece talking about there would have to be a regime change to get inflation to move, even get up to 2% and stay there. Again, thought leader. But in terms of this most recent episode, going to have to move more, going to have to move faster, rates are going to have to be higher, and continuing to push in that direction. He obviously, in the end, isn't the only one.
Right.
But again, Jim has been, I think, a big monetary policy thinker, and in terms of actual policy steps, he has been a major force as well.
All right, don't go too far in conversation right now with Kathleen Hayes. The news here that Jim Bullard, St. Louis Fed president, planning to step down here to take over as head of the Purdue Business School. Liz Ann Saunders is still with us, managing director and chief investment strategist over at Charles Schwab. Our apologies to you, Liz Ann, for cutting you off there. But as you can see, this is a pretty big deal. I mean, Jim Bullard, not only a longtime member of the FOMC, but of course one of the more vocal members of the FOMC. What do you make of this?
So certainly one of the more vocal members. We don't know who will replace him. So as to whether somebody steps in that is equally vocal, that time will tell. I think this would have been maybe worth more of a consideration in terms of, okay, what does this mean for Fed policy? Consideration in terms of, okay, what does this mean for Fed policy? If we weren't at a point
even though maybe not in a voting capacity. Bullard, of course, is a thought leader at the Federal Reserve, and we are barreling towards the July meeting. And Lizanne, to your point, there's a lot of unanimity on the Fed board right now. We haven't seen dissents necessarily under Powell that had maybe been expected. When it comes to the July meeting, it seems like
inflation front and the labor market front.
We've been having a lot of debates here off camera, Lizanne, kind of about the idea that maybe the Fed won't be as important for the market in the way that it was, of course, during the big bull market cycle when they kept rates at basically near zero, and then over the last couple of years as they ratcheted up rates to 5% here. Is there a sense here that with their job maybe potentially done, that the market can then, I guess, decide to obsess over something else rather than what Jay Powell, Jim Bullard, and the rest of the cohorts are saying?
Well, I guess it depends on if the market goes back to pricing in a pivot. I think the Fed has finally done a somewhat successful job in getting the market to understand that pause and pivot are not the same thing, and the conditions for an actual pivot to rate cuts just don't exist. Even if we were to persist in this disinflationary trend, I think what Powell and most others on the Fed want to try to avoid are the fits and starts that occurred under Burns in the 1970s of declaring victory and not just staying at whatever the terminal rate was each time, but easing policy only to see inflation come out of the bag again. And that's ultimately what led to Volcker having to pull a Volcker, as we now like to say. So I think it's that pause era that, assuming the market does adjust to the fact that higher for longer is likely what the Fed is telegraphing. But if the market starts to price in cuts and the Fed digs their heels in, that could be a potential risk. I just don't see that as imminent.
Well, besides what the swaps market is pricing and what the bond market is pricing, let's talk about what the equity market is pricing in, because we're looking at a pretty robust risk asset rally in the past couple of months, of course, building on the start to the year. Is that pricing in cuts, or what is being priced into the equity market at this point?
So I'm not so sure cuts are priced in, but a pause sooner rather than later. I think also what the market is pricing in is a better earnings outlook, and at least the hope that second quarter earnings end up looking like first quarter earnings, which is the bar gets set too low, companies beat expectations, and you have this sense of a firm bottom in earnings, even if the acceleration is not significant. Therein lies a bit of a risk, because what happened in the first half of this year, which, by the way, was the complete mirror image of what happened in the first half of last year. First half of last year, you obviously had the beginning of a pretty ugly bear market. Interestingly, though, it was all multiple contraction because earnings were growing in the first half of last year. Fast forward to the first half of this year, the rally has been all multiple expansion without any benefit accruing from E. And in addition, we've had very strong nominal revenue growth, but we now have no real revenue growth. Revenues are in negative territory in real terms. And I think it's always an interesting question to talk about the bond market versus the stock market, because I think the bond market tends to live in the real world. I don't mean that generically. I mean specific to real interest rates, real economic data, where I think the stock market tends to focus more, live more in the nominal world. And we may be now at a pretty important inflection point because of that differential, especially in something like nominal revenue growth still strong, but real revenues in negative territory.
All right, Lizanne, always appreciate you taking time for us, and definitely appreciate you sticking around for the breaking news today and giving us your insights. Lizanne Saunders, Managing Director and Chief Investment Strategist over at Charles Schwab. We're going to continue now here with the big breaking news of the day. The Federal Reserve Bank of St. Louis President Jim Bullard going to be stepping down to take over as Dean of the Purdue University Business School. Still with us is Kathleen Hayes, who covers the Fed for us and knows Jim Bullard very well. Decades-long career, really, at the FOMC. And Kathleen, I was just kind of looking back. I remember late last year, there was a great profile that Bloomberg wrote about him, where he sort of referenced why he had kind of become kind of that non-consensus figure on the FOMC. And he gave this anecdote about how he was trying to buy this bicycle. And in the process of this transaction, the price changed. And he was like, Bill, that's not how transactions are supposed to work. You agree to buy something at a price and you get it for that price. But but I thought it was a great anecdote because it really sort of showed you just how dynamic this economy is in a negative way at that time, but also why he seemed to justify some of his non-consensus opinions on what the Fed should do next.
Well, last year, this is 2023, we were done with the pandemic pretty much, right? But that was still what we were reacting to. I mean, monetary policy changed dramatically when the pandemic started, and they just slashed rates quickly to nothing. Tons of quantitative easing, lots of bond purchases, and all kinds of special programs. So when the Fed started coming out, they were kind of reluctant. I think they were afraid. They're always afraid that, oh, is the economy strong enough yet to get started? And I think Jim, in fact, in March of last year, Jim dissented against the 25 basis point rate hike. Yeah. Not because he didn't want to hike, but because it wasn't big enough. He thought then they should have moved 50. I'm looking back at an essay he put out in March last year, saying, in my view, raising the target range 0.5% or 0.75%, and then starting to reduce the balance sheet would have been more appropriate actions. Again, way out in front of everybody else on this. I mean, the whole thing was kind of difficult for the Fed to manage. Yeah. But again, Chris Waller, who was his graduate school professor, University of maybe Nebraska. Yeah. What he said when this young guy came in, he was so smart. Yeah. From the very beginning. He was just, and again, this very modest, kind of soft-spoken person who over time, I think, obviously embraced his role. I was just reading something else in 2014. He was touted or tallied up to be the 7th most influential economist in the world. Yeah. And for the longest time, those of us who cover the Fed have noted that who moves the market most. I think that shifted a bit. It's kind of spread out more. But Jim Bullard has always been the one that the markets listen to. Yeah. He was certainly the one that we watched the most, at least over the last few years. But one more thing that might be going on, you guys, when you turn, it's funny, you can be at the Fed Board of Governors, you could be the, you could be the vice chair, you could be the chair. You can reign until your 80s. I mean, how old was Alan Greenspan when he stepped down? Absolutely. For some reason, the 12 district banks make their presidents retire when they turn 65. That's why Esther George stepped down last year. And Jim, I'm kind of calculating at the back of my hand. I think he's about 62. So I have no idea. I'm still surprised that he would leave a day before he had to step down. But perhaps there's something going on we don't know about.
He's got another job. Maybe he feels like that's a better opportunity. He gets to stay in the Midwest. Kathleen, great to always have you here. And really thank you for jumping on here.
Yes.
And if you take a look at the story as it's developing, we are learning that the St. Louis Fed's #2 official, Kathleen O'Neill Pace, I hope I'm pronouncing her name right, she is going to become the interim president effective immediately. The bank's board will begin a search that's robust, transparent, fair, and inclusive. Let's get more on this story with Bloomberg economics and policy correspondent Mike McKee joining us right now. And Mike, as we've been reflecting on, I mean, Jim Bullard, you know his voice. He is vocal. With him stepping down, I mean, who stands to occupy that sort of thought leadership that he's really pioneered?
Well, at the moment, there probably isn't somebody among the bank presidents who would assume the role of sort of the outsider, the one who looks at things differently. Chris Waller obviously has a longtime connection to Jim Bullard, and Waller's on the board of governors now, so he might step forward even more than he has, but he has taken a sort of leading role there. And you might think that perhaps an Austin Goolsbee might do that, given his his economic background. We're also looking at Lori Logan out of Dallas. She's been a slow starter in terms of speaking publicly, but she is turning out to be one of the most hawkish members of the Open Market Committee. So somebody's going to be replacing Jim as sort of the person who looks at what needs to be done immediately, but I'm not sure who exactly that is. So, by the way, I did look it up. Kathleen's question about when they have to leave. Jim Bullard could stay until 2026 if he wanted to.
Yeah, he turned 62 earlier this year. I am curious, Mike, for our viewers that don't understand all the ins and outs of this selection process, just kind of walk us through it here, because this isn't really a political appointment in the way that some of the other governors are. These people are basically selected kind of by the cadre within the bank itself. They don't necessarily have to go through that congressional review process in the way that sort of Jay Powell would have to go through.
No, the presidents are selected by the board of directors for each bank, and within that board, they set up a search committee. They announced a search committee today because, of course, Jim is resigning effective today. And they will take a few months to sort through candidates, see who they might be able to attract or who might be promoted from within. And then once they have reached agreement on who they would like to hire, they do send that name to the Federal Reserve Board of Governors. And the Fed board can reject a candidate, but that's the only thing that they can do. So it's really going to be up to the board of directors at the St. Louis Fed. Now, it brings up an interesting situation because Missouri, oddly enough, is the only state with two Federal Reserve central banks. Kansas City is the other. And Kansas City, it's been 18 months since Esther George left, and they haven't been able to settle on a successor. So it'll be interesting to see if St. Louis can beat that, or if there's something about the Midwest that slows the process down.
All right, Bloomberg is Michael McKee out there in Idaho. We're going to check in, I'm sure, with him a little bit later here in the program with the big news of the day, the news that is going to dominate the conversation today. It's Jim Bullard stepping down from the St. Louis Fed. We'll get back to that story as well as what's going on in the broader markets, but let's actually stay out there in Idaho and go a few miles away into Sun Valley, where Ed Ludlow is standing by right now with an exclusive interview. Ed, take it away.
Yeah, thank you, Romain. Here in Sun Valley, there's a name on everyone's lips, but he's not here. He's touched down in Miami, and that is Lionel Messi. We're joined by Major League Soccer MLS Commissioner Don Garber. Give me the absolute big picture. How does the MLS benefit from Messi being here now?
You know, when you have the most successful, greatest player in the world, somebody who's played the game at a level, at the national team level, at the club level, in ways that have inspired and entertained and excited and thrilled people for a decade. In our league, having him say Major League Soccer, his league of choice, not Saudi Arabia, not FC Barcelona, it adds just a level of excitement, credibility, and just enormous enthusiasm behind our league.
And money?
And obviously massive financial opportunity, and I'm sure we'll go into that. But
look, the ink is not dry on that contract, but my understanding is 150 million a year in cash, a big number, a share of the team, some sort of ownership, and then you have Apple TV profit sharing. How did that all come about? Who was influential in that agreement?
I'm not sure about the 150 million a year as opposed to perhaps that over the term of his contract in terms of salary. But obviously, an enormous amount of money that includes not just what he gets paid, but the uniqueness of our league. Having a partner in Apple that can share in helping us attract someone like Messi. Partnership with Adidas, who can come in and be part of that program.
Was that your idea?
It was our idea. The league does all these unique things. We've talked about David Beckham and the uniqueness of that deal. We've got partners in the league office in terms of how we're structured, and a very ambitious owner in the Moss family in Miami putting together a deal that I think was more attractive to Messi and his family than playing in Saudi Arabia, and we're going over back to Barcelona where he'd been before.
The question that comes next, and it has been raised by the Moss family, is how you replicate the model. So Messi gets a share of the team. Is that going forward how you bring the absolute top tier of player from Europe in particular?
Yeah, you remember Beckham had an option on a team, something for an expansion team. It took 10 years. That option was exercised in Miami with Jorge and Jose Mas. We'd never do that again. And though you never say never to anything in life, the likelihood of ever having a situation with a player where they get an opportunity to participate in equity is probably something that we'll never do it again. There was only one David Beckham. There's only one Lionel Messi. But, you know, who knows? Mbappe wants to come into the league, and a team in our MLS wants to do something unique. MLS is ambitious and innovative, and who knows what kind of structure we'll come up with.
Commissioner, there's the reality and the scale of this league and these teams. I think Inter Miami are expanding the Fort Lauderdale Stadium, but how flexible can you be in helping them look at other options to build up the scale of attendance, to grow that franchise to another level?
Well, you know, we have a unique model in MLS. Soccer stadiums have been built throughout the United States and Canada. We just opened up our 26th in St. Louis this season. Fort Lauderdale was a temporary stadium. They're going to build a new facility in downtown Miami called Miami Freedom Park. So for Lionel Messi's tenure in MLS, they're going to have to make it work there. All the unique hospitality opportunities, ticket pricing, as you know, has really been extraordinarily high. There'll be unique opportunities to generate new revenue. They'll announce a new Adidas MLS jersey sponsor, both on the front and on their patch, things that would be almost unheard of in terms of the levels of revenue. But the stadium is the stadium, and they're going to have to figure out a way to make it work.
You mentioned that this was a competition between Saudi Arabia. My understanding is Barcelona also thought to bring their son home. You won. What was the one biggest factor that brought Messi to the MLS?
You know, America's a rising soccer nation, and our league is driving a lot of that momentum. And you get a generational player who has an opportunity to not just have a legacy as the best player, the GOAT, if you will, but also be part of driving enormous momentum for the years leading up to the World Cup. Copa America will be here next summer. The FIFA Club World Cup will be here in 25. U.S., Canada, and Mexico will host the World Cup in 2026. And Messi will be the continual part of that narrative. He'd make a lot of money in Saudi Arabia, and I'm sure that was attractive to him. Go back home, as you said, a favorite son.
You raise a great point, though, in that Saudi is so present in professional football, soccer. Have you met with the Saudis about investing in the MLS?
No, we haven't, Ed. But interestingly, years ago, when they were forming their league, we did the same with the Qataris. We advised them. You know, MLS has a unique structure. It was an emerging league that had to capture this unique opportunity. The Saudis are heavily invested in trying to make their league more successful, more popular. The Saudi folk, the people who live there, are very passionate about the game. The Chinese have tried to do that with the president, try to make football a big part of the unique experience for fans. We'll see how it all plays out. It certainly is an intriguing, disruptive part of what's going on in our sport.
Are you broadly open to sovereign money investing at a franchise level or in the league?
We are. And beyond the uniqueness of our structure, where we have private equity investing in our league, Ares Capital invested in our Miami team just very recently. But the NHL and the NBA have looked at having sovereign funds and pension funds. MLS looking at the same thing. Very timely news. We'll likely discuss that at our board meeting in in D.C. next week at our All-Star game.
So my final question is on valuations, because I had Steve Pagliuca on with me yesterday, co-owner of Atalanta, just made the Europa League. Not interested at this time in an MLS franchise. Is that because valuations are crazy? There are some examples out there where clubs are in the hundreds of millions of dollars.
Well, it's, the average is, almost 600 million. Teams that are raising money at almost $1 billion. And it really speaks to the opportunity. A global first unprecedented partnership with Apple, which has an unlimited potential for revenues. So when you think about investing in Major League Soccer, it's not just where we are today. It's like all investment. I mean, this is what we're doing here in Sun Valley. What will the valuation be in the years to come? And with partners like Apple and players like Messi, stadiums being built, the World Cup, rocket fuel driving the future of our league, I think the opportunities for increased valuations are endless. I think that $1 billion number is the right valuation for where we are today. And when we're together next year, I think the valuations will be even higher.
We will hold you to that.
There you go.
MLS Commissioner, Major League Soccer, Don Gubby. You have to take my word for it, Romain, that Messi is what everyone is talking about over here. That and Bob Iger.
All right, there you have it. Ed Ludlow out in Sun Valley. Meanwhile, back here in the U.S., everyone is still focused on the big news of St. Louis Fed President Jim Bullard stepping down. We're going to get back to that story in just a little bit. We do want to check in on what's going on in the market as equities rally here for a fourth straight day. Treasury yields continue to move down and a bit of activity in the commodity space. Abigail Doolittle standing by right now with our commodity close. Abigail.
Well, Romain, with the down dollar, we have another day of rallying for commodities. In fact, the Bloomberg Commodity Index up 5 days in a row. I believe it's the best 5 days since the middle of June, so almost a month. Take a look at oil up 1.5% on some supply concerns around both Libya and Nigeria. We have silver and platinum higher. I don't know that there's a specific reason. That down dollar might be just enough. And then the Bloomberg Canadian, I think that was actually supposed to be corn rallying in a big way, and this has to do with some problems with the Brazilian harvest. Now, there is one other commodity on the move. Cocoa, Romain, is on the decline today, but we have a pretty dramatic chart here, and I wish I understood it a little bit better to be able to explain it better, but Cargill has been building this massive position in cocoa over the last 2 years, so much so that the premium that to short it, you need to actually have the cocoa in hand. In any case, the spread between two different cocoa futures, Romain, you can see the dramatic volatility there. Stay tuned, more to come on it.
Yeah, I've been completely obsessed with this story. Abigail Doolittle there with a look at some of the commodities action, including, of course, that big fat finger trade here in the cocoa market. Let's stay in the commodity space right now because we started this morning with the big deal being announced by ExxonMobil, saying that it's set to buy Denbury for about $4.9 billion. This is going to be the biggest acquisition in about 6 years for Exxon. But what does it mean? What exactly are they trying to do with this deal? David Wethy joining us right now. He leads Bloomberg's U.S. energy coverage. And I do want to start there, David. There's something more to this acquisition than just $4.9 billion. What?
Absolutely. It's the future of really Exxon's enhanced oil strategy, or more likely the low carbon oil strategy for this oil giant. What they want to do is they want to use this massive pipeline network that Denbury offers. It's the largest in the world for being able to move carbon, basically, and so you can be able to store it underground. And that carbon capture is the cornerstone for Exxon and for being able to have this low carbon strategy. And if it's going to do that, it's got to find a way to move all this carbon around. And that's where the pipeline network really comes in.
And David, I understand that pipeline network is very valuable for moving carbon around, as you say, but why didn't Exxon just build this out itself?
That's a great question. It's because right now it's almost impossible to build pipelines at all for low carbon purposes or for moving oil for production or anything else. You just can't get the permits to build pipelines. So Exxon and others have been trying for a while, and ultimately that's why Exxon is willing to pay so much for it, is because there's really no better option out there. So it's going ahead and buy this network that's already in place. 70% of it is down on the Gulf Coast. Some more of it is up in the Wyoming area where Exxon has some operations and is taking carbon out of the air as well. And so this plugs well perfectly for Exxon's footprint.
All right, David, I'm going to have to leave it there. Interesting price reaction today, of course, in this all-stock deal, $4.9 billion. ExxonMobil shares down 2%, and I guess the premium for Denbury shareholders not quite enough to do anything for that stock. That's down about 1.6%. Stick with us. A lot more coverage coming up. This is Bloomberg.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
Well, of course, let's get back to that breaking news, which is Federal Reserve Bank of St. Louis President Jim Bullard has resigned after 15 years in the position to become dean of a university's business school. For more, let's bring in Kathy Bostjanik. She is chief economist over at Nationwide. And Kathy, I want to get to your views on inflation and the Fed's path from here. But to start, I'd love to hear your reaction to Jim Bullard stepping down. Of course, one of the most vocal and one of the most bullish voices at the Fed.
Yeah, happy to be with you. Surprised to me, frankly, probably to everybody or who wasn't in the know on this. But you know, certainly, I think it's a loss. He has a lot of experience, institutional knowledge, but also great insights on the economy. You know, I think back when he first proposed something that was somewhat revolutionary on the FOMC, talking about regime shifts and saying that at one point that's when we were in a low interest rate, low inflation environment, and he would even forego the normal practice of providing a long-term dot plot estimate because he said it was unknown, not as much certainty about the long run. So he's a really quite an innovative and I think leading edge member of the FOMC. So I do think it is a loss there.
And of course, we remember that Bullard, he was one of the most vocal against the characterization of inflation as transitory. And for a long time, he was right there. And when you think about the path that inflation has taken, we're back down to 3% on that headline CPI print. But do you see any risk that inflation could actually reaccelerate from here?
Yeah, I mean, the base effects are pretty volatile at this point because we came off of very strong prints last year. Like, for example, June, the month-to-month gain was up 1.2%. A lot of that was because gasoline prices at the time were, on average about $5 a gallon. They've come down quite a bit, around $3.50 or so. So that's helped take a lot of the air out of inflation. But it wasn't just gasoline, other factors as well. And I think we're in the camp that getting from, this 3% to 2% is going to be very hard. And as you alluded to, we're actually going to have the base effects working the other way in July and August, where the year ago the prints were very low. So it's going to make, it could be the year-on-year rate starts to bounce back higher. From our vantage point, we really think at this point you got to focus on the core, because that takes out the extreme movements in energy prices. And when you look at core, really look at also the 3-month annualized rate is along with the month-to-month and year-to-year change.
So that gets us back to this whole idea, though, about the labor market's role in all of this, Kathy. And I know that probably when we get the Fed meeting in a couple of weeks and that press conference, there's going to be a lot of discussion about payroll growth, wages, and I guess some of the persistence that we continue to see there.
Yeah, no, absolutely. Even though we saw some cooling in private employment, which is welcomed, and I think it was notable, but still a very tight labor market. We saw that with the unemployment rate falling back to 3.6%. And as you said, wages on a month-to-month, year-on-year basis are still quite elevated. Pre-pandemic, you saw wage growth between 3.5%, we're well over 4% still. So that, I'm not sure that on its own, causes inflation. But as many Fed officials have alluded to, it could prevent inflation from going down as quickly, right? As more people are making higher income wages, they're going to spend more freely. And with the unemployment rate still low, that's a recipe for still keeping upward pressure on inflation and consumer spending.
This gets us now back to, I guess, what everyone in the market really wants to know, Kathy, and that is that once we get what most people presume is that next rate hike in July here, is there any sort of argument that you can go into that meeting in September and say we need to continue raising rates?
It's a lot tougher now, and that's what we see, in the price action in the bond market. The expectations of another rate hike after that July one had declined quite sharply, and the 2-year Treasury note yield has dropped precipitously over the last week or so, above, was at 5% just, not too long ago. So I think it becomes a lot more difficult, and I would think that the hawks are kind of assuaged. They're not going to declare victory because they don't want a repeat of the 1970s, 80s, right, where the Fed eased off a bit and took for granted that inflation was going to continue trending lower. So they're going to still be vigilant. But I think this idea, this is a new idea really for the Fed, is to not cut rates if growth slows. So that's revolutionary in its own sense, right? It doesn't mean that they have to keep raising rates, but just holding at an elevated level for a long period, even as inflation trends lower. In real terms, the Fed funds rate moves higher. And I think that's really what they're focused on right now.
All right, Kathy, always great to catch up with you. Kathy Bostjancic, Chief Economist over at Nationwide Mutual. As we walk through, of course, the big stories of the day, another soft inflation print encouraging the market, the resignation of Jim Bullard over at the St. Louis Fed, and the start of earnings season kicked off today, and that was with Delta Airlines. A pretty interesting report here now with the shares kind of oscillating between gains and losses, up about 0.8% right now on the back of better than expected second quarter results. Joining us right now to talk about, well, whether he was surprised by what we heard today is Stephen Trent, Managing Director and Airlines Analyst over at Citi Research. All right, Stephen, let's start off. Ed Bastian has been pretty bullish, vocally bullish about the prospects for his company. I think a lot of people doubted him, but that report we got this morning seemed to back up that language.
No, I absolutely agree. And when one looks at the demand indicators, there was certainly a fair bit of doubt when we look at what happened after the first quarter, where there were some indications that close-in bookings were a little light. And I think that the street, in my mind, was erroneously comparing what close-in bookings looked like pre-pandemic versus what they look like now. So demand has evolved. We continue to have a very good demand outlook, along with a paucity of capacity on a per capita basis. And we think it's a good setup for Delta and for the group.
Well, when we talk about what's changed in terms of demand when it compares to pre-pandemic, of course, we have to talk about business travel. And we did hear from the C-suite saying that they expect business travel basically to steadily increase into the fall, but it's going to be modest in terms of growth rates, as it's been for some period of time. Are we ever returning to those pre-pandemic levels when it comes specifically to business travel?
You know, I am not convinced that we are. And part of the reason I would say that is because most people today are not in the office 5 days a week. I mean, I know there are exceptions out there, but when I think about the greater flexibility today on a work-life basis, that work-life flexibility has indeed impacted the way people travel, the way people purchase goods and services, including ticket purchases. So we think there's going to be more of a migration, for example, away from traditional managed business travel towards blended trips, which is not to say that managed business travel is not going to continue recovering. We think it will, but it won't have the scale that it had in 2019 relative to other subsegments.
When you look at the earnings that we got out of Delta today, do you think that's going to carry over? We're going to see a similar narrative out of American, JetBlue, and some of its competitors when they report next week.
Yeah, no, great question. So I think if you're looking at where the momentum was, I mean, the places to me where international long haul is really spooling up nicely, transatlantic, transpacific. Delta's really making big gains on loyalty, co-branded card revenue. And in the domestic market, its main cabin is also doing well. I think when we look at some of those other competitors that have less international long haul, we're maybe not quite as sanguine on names like JetBlue, for example. I think the other thing that Street's going to watch is the unwind of the Northeast Alliance. So I think that we did get some revenue tailwind from that, and that makes JetBlue at least somewhat vulnerable over the next couple of quarters.
Stephen, really appreciate your time on this busy day. That is Stephen Trent, analyst over at Citi. From New York, this is Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
City, in London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Welcome back to Bloomberg Markets to Close. Time now for our Wall Street Week segment with David Weston, who joins us every day at this time. David, a lot of news out there today in the crypto space. Exactly. I think we have a great guest to talk about.
Fortunately, we have somebody who knows it really backwards and forwards. He's Tim Massett. He's former CFTC chairman, fellow at Harvard's Kennedy School, and a member of PayPal's Advisory Council on Digital Currencies. Tim, thanks so much for joining us. As Romaine said, there's a lot of news today. Among other things, that Ripple decision. Everybody's been waiting for it in this area, and I would say it's sort of Solomonic. I mean, sort of there's something for everybody. Explain that decision and whether you think it makes sense to say sometimes XRP is a security, sometimes it's not.
Well, we're still sort of waiting for the full opinion, or at least I haven't seen it yet. But from what I have read, the judge decided for Ripple on some very important claims and therefore ruled in favor of its summary judgment motion, but allowed some of the SEC's claims to go forward. I think the key issue here is how does it end up interpreting the Howey test overall? You may recall the Howey test is what we use to determine whether a crypto token is a security. And it sounds like the judge leaned more into sort of Ripple's camp than the SEC's, in the sense that it appears to say that unless the arrangement really created some post-sale rights and obligations between the parties, then maybe it's not a security. Now, again, we sort of have to analyze the full decision to really make sure of that, because the judge did allow the claims on the institutional sales to go forward. The institutional sales had a lot more optics and color around them that looked like normal security sales, whereas the retail sales, the programmatic sales did not. So we'll have to wait to see.
Yeah, important. We have to wait and see. Fair point. There is a little irony, at least in the initial reports, that it's the institutional people that need protection and the retail people don't need protection. But let me ask you whether the markets you think might be getting it right, because up. Last time I checked, it was 25, 27% up. Do you think the markets got this right?
Yeah, I mean, it did, as did some other tokens. So again, if the judge basically interpreted the Howey test in a more conservative way than what the SEC was arguing, then it is very significant. But look, it's still not going to resolve some of the basic issues we have of how do we regulate this industry. And that's kind of what I've been arguing all along. We've been too bogged down in these questions of, is it a security, is it not a security, that have prevented us from putting in place some reasonable standards to protect investors, but also to encourage innovation.
Well, I mean, it raises a question here, Tim, too, as to whether the industry is going to continue waiting. I mean, there's been a lot of talk about some of these ETF filings, BlackRock, Invesco, WisdomTree, just to name a few. These are big, established institutional players who at least feel like that maybe there's a chance that this could get approved. Why not?
Yeah, that's true. So on the ETF issue, the SEC has not approved a Bitcoin ETF in the cash market. And it has said that's because that cash market isn't well regulated. Now, BlackRock and others have come forward with some ideas on surveillance that they're hoping would persuade the SEC. And I should note that the SEC has approved an ETF based on Bitcoin futures, because those futures contracts are traded on CFTC-regulated exchanges. And, of course, it's being challenged in court on, well, why have you approved the futures ETF if you're not willing to approve the cash ETF? But, you know, the whole ETF issue is a bit ironic in that Bitcoin and crypto tokens were meant to be things that we all bought and sold on the blockchain. Of course, that hasn't happened. Most people buy them through large centralized intermediaries. And now, of course, we've got BlackRock, of all people, and other conventional asset managers offering ETFs on these tokens. So it's an important issue, but I think, again, we still have these overall issues of how do we regulate this market.
Well, why is this taking so long? I mean, you know the CFTC inside and out, and I know it's not an easy job, particularly for a financial product that effectively didn't even exist more than a decade ago here. Right. But this has been a long time coming, and we still don't have a resolution.
It's a number of things. One, I think regulation is always slow to catch up to innovation. Two, this type of innovation was different from what we often see in the financial sector. We often see intermediaries that are already regulated coming forth with new products or new innovations. So regulators kind of know what to do. Here, this whole sector was global from the start, and it was retail from the start, and that kind of caught regulators flat-footed. The third major thing I would point to is particular to the U.S., which is that we have a very fragmented regulatory system. We have different regulators for different products. That has made us slower, I think, to respond. But having said that, you know, other jurisdictions maybe are a little bit ahead of us, but they're still developing their frameworks too, and they're hitting some of the same issues we're hitting.
Well, and Tim, you have a proposal that I will call sort of general guidelines from SEC and CFTC, and then a form of self-regulation. You've joined with Jay Clayton, the former head of the SEC, in an op-ed. Are you getting much pickup on that?
We are, and let me maybe just take a moment to explain it. What we're saying is we're all for strong enforcement. We're just saying there needs to be a supplemental path so that we can create some standards for this industry as it exists today, for these trading platforms as they exist today, without being hung up on this question of which ones are securities and which ones are not securities. That can go on, that can get litigated, but let's put in place some standards. So we're saying the SEC and the CFTC should get together to develop those. They can do those through a self-regulatory organization, but let me just say one final thing. By self-regulatory organization, we don't mean something where the industry goes off and figures out on its own how to regulate itself. We mean something tightly supervised by the agencies.
A terribly important point. Thank you so much, Tim. Really great to have you with us. That's Tim Massett. He's former CFTC chairman and Harvard Kennedy School of Government Research fellow.
All right, we're going to catch up with David Weston, of course, as we do every day at this time for our Wall Street Week Daily segment. Getting ready to reset, though, for the final hour of trading. You're talking about crypto. You are seeing not only a modest bid into the crypto space, but actually more some of the companies. Coinbase having a phenomenal day, up about 7-8%. The broader market rallying for a fourth day here, and you're seeing another downdraft.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. It is Thursday, July 13th, 2023. Carol Masser along with Matt Miller in for Tim Stenivek here in our Interactive Broker studio on YouTube and Bloomberg Originals. Matt, I thought we were going to be leading with, again, another weak U.S. inflation report, but really it's about Jim Bullard now.
Yes, I mean, it's mostly about Jim Bullard. It's also about S&P 4,500.
We did hit it, huh?
We've crossed a milestone. Yeah, another rally for stocks. I mean, we got this PPI number in the inflation that you're talking about, right? At 0.1% month over month, and also 0.1% year over year. So, the word disinflation being brought back into the vocabulary, and stocks rally, not just stocks, bonds rally, oil rallies. So across asset classes, you're seeing risk on.
Yeah, but those big mega caps really fueling the surge to the upside. We are going to talk, though, about Jim Bullard stepping down as president of the St. Louis Fed. He's been a known hawk out there early when it comes to inflation concerns. So we're going to get into what that means, losing that voice, and then maybe who takes his place. So we'll get into all of that. We're going to also talk about, there's like a fair amount of stuff going on in the energy space.
Yeah, there's a lot going on in energy with Exxon buying a pipeline, a CO2 pipeline.
Right.
Which previously was used, I believe, mainly to get oil out of the ground. Now they're going to use it, hopefully, to put CO2 back into the ground. So kind of going the sustainability route. On the other hand,
Is
you have...
it really,
yeah, for sure.
Well, yeah, I guess. Yeah, I guess.
I mean, very much so.
Yeah. Yeah, okay. There's like different ways to do it, like to kind of get off all of these fossil fuels too.
Yes, we could. That's also another way to do it. But getting CO2 out of the atmosphere reduces the human effects of climate change. On the other hand, you have Shell, which is selling a sustainability business.
Yes.
So one gets in, one gets out.
Yeah, right. Their holdings in some of their renewables. Hey, also we're going to get to just kind of a preview, big bank earnings. We know that there's a lot of pressure, so we're going to dig into that. A most read story on the Bloomberg about former JPM banker Jess Staley and deceased convicted pedophile Jeffrey Epstein. A lot of emails between the two. I know you and I have been going kind of back and forth about this one, but nonetheless, it's the Bloomberg Big Take, and people are talking about it. And then a guest you brought to us.
Yes, Jessie Draper is going to come on. I've known her for years. She was on a TV show, a Nickelodeon show, the Naked Brothers Band, when I was a little kid. And now she is, when she was a little kid.
Yep.
And now she is leading a venture capital firm that focuses on women.
All right, now, Countdown to the Close starts right now.
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Romaine Bostick alongside Katie Greifeld, joined now by our colleagues Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. A market higher once again on the day, yields lower once again on the day, and a big surprise just a little more than an hour ago, learning that the St. Louis Fed President, Carol Masser, James Bullard, going to step down. He had been there for quite some time. I kind of forgot how long he had actually been in that position.
Yeah, it's not just about 4,500 on the S&P, as Matt reminded me today as we hit that level. No, about an hour ago, right, a headline crossing the Bloomberg terminal and reminding us that the president of the St. Louis Fed, not reminding us, telling us that the president of the St. Louis Fed, Jim Bullard, will be stepping down. He's going to head the Purdue Business School. But as you said, Romaine, he's been a voice there for a long, long time. He's a noted hawk. And if you recall, very early on, as inflation continued to tick higher and remain persistent, he was really out there saying, we've got to be more aggressive when it comes to interest rates, Matt.
That's absolutely true. He was also out there saying we need to be more aggressive when it comes to quantitative easing in a couple of cases. So I think he's gone in both directions in terms of Fed policy, but he's been kind of a canary in the coal mine if you're trying to look for a change in direction throughout his 15-year tenure.
A bellwether, if you will, because, I mean, the point has been made again and again that he's not a voting member, but I think that's exactly right, Matt, that he's who you listen to when you want to get a sense of where the Fed's going.
What were we listening to him because of what he was saying, or just because he was more vocal than some of the other members?
That's, yeah, you know, sometimes people who are more vocal get noticed more often, as you well know.
But I will say he was right early out there when I think the Fed was still kind of sticking to this is going to come down. It's not, the whole idea of transitory. Remember we used to talk about that all the time, and then we stopped talking about it. But he was out there, it feels like, front and center. Maybe he was a loud voice.
He poo-pooed that.
He was a loud voice, but I mean, in fairness to him, I mean, he was kind of a counterweight, I think, for a while, at least during when this sort of rate tightening cycle kind of started, or rather didn't start initially, and then finally got started. And he was kind of that counterweight, I think, to some of the other drum beats that we got out of the other Fed members. And you remember that great profile that Bloomberg wrote about him, I think, back in October, where he kind of gave the anecdote about him trying to buy this bicycle and how the price changed on him while he was in the middle of doing it. And he used that as an example of just kind of addressing this whole issue of, this ain't transitory. There's some structural issues here that the Fed needs to address.
And I think it's that counterweight that you identified is why we listened to him, that he would take the other side frequently, and obviously we heard a lot about it. And in his absence, even though, again, he has seemed to play both sides here, I mean, who is the most vocal hawk? Who are we left with? Is it Neil Kashkari, who's someone else who has switched sides?
I thought he had flipped to dovish or something.
Well, he was dovish, right?
Yeah, now he's kind of hawkish.
I can't keep up.
So it's like, we often do this when we talk with our Mike McKee, right? What are the most important voices? Of course, it's Jay Powell, but Bullard was always up there. So you do think about what are those handful, or what is the handful of guiding voices when it comes to Fed speakers that you really need to pay attention to? Bullard was one of them.
And that's an important point, Carol, because, I mean, people forget, right? It's not always about the policy mechanisms. It's about the communication. And that communication is what moves markets. And I think to Matt's or whatever, I don't know if it was you or Matt were saying it, but, we paid attention to him for that reason, or the markets did. And just to be clear, I mean, he's not a voting member now. Obviously, I think the St. Louis Fed comes back in as an alternate next year, and then a full voting member in 2025. But you ask who the hawks are, I mean, you go through the list here. I don't know. Lisa Cook, Austin Goolsbee, Patrick Harker, Philip Jefferson, Lori Logan, Chris Waller. I mean, what do we got here?
And I think Logan is one that we really listened to a lot lately.
Yeah.
She's come out with some catchy phrases. And on the dovish side, Raphael Bostic has come up with passive tightening, right? Which is all the rage right now.
Passive tightening.
Passive tightening. That's a new one. A new phrase.
That's when inflation continues to come down, so real rates rise. The Fed doesn't actually have to do the work.
What is that? Is that like jumbo shrimp or what? I don't understand.
A little bit pregnant? Like these things just don't happen. All right, guys. Whoa, we're going to continue this conversation in less than an hour's time. We're going to come back at 4 p.m. Wall Street time. Our cross-platform radio, TV, YouTube, and, of course, Bloomberg Originals. Join us for Beyond the Bell. All right, everybody, we're going to stay with it. We're going to talk a little bit more about that news regarding Jim Bullard. We're also going to talk about, as Matt mentioned at the top, 4,500 on the S&P 500. I mean, what worries? Everything's awesome. So let's get to it, though. Bloomberg News International Economics and Policy Correspondent Michael McKee on Zoom from the Rocky Mountain Economic Summit in Idaho. There he be with the hat and all. We love it. Is that a new hat?
Yeah, that's a new hat this year. It's hot out here. Oh. You want a straw hat.
100%. But you're supposed to buy those in winter. Tom Keene tells me straw hats in winter.
Well, I don't really listen to Tom about cowboy fashion.
I've yet to see him
in a cowboy hat. If I need bow tie advice, I'm all over Tom.
No, it's just because you get a deal. Get it, Carol? You get a deal if you buy the straw hat in the winter.
You're doing a lot of...
That's not mansplaining.
You're doing a lot of mansplaining today.
I'm telling Mike through you. I'm using you as a...
All right. Just Matt, and also in the House, Bloomberg News Deputy Team Leader for U.S. Equities. Matt, excuse me. Mike, let's start with you. That news at, I think it was 2:03 p.m. across the Bloomberg that we had, the news about Jim Bullard. What does this mean for the Federal Reserve?
It probably doesn't mean a whole lot. Jim Bullard was a somewhat influential voice, but often a lonely voice because he came up with different ideas about how to do monetary policy and wasn't always in the consensus. So one vote that way doesn't make a difference overall. But he had been around for 15 years, so he carried some weight, and he certainly got a lot of publicity talking to the press. So he sort of helped set the agenda for the Fed, and we won't have somebody immediately who would fill that role. So in that sense, it's a loss. But he doesn't vote, St. Louis doesn't vote again until 2025. So it isn't going to make a huge amount of difference for the time being.
How do we find out who's going to replace him? Is there a list of successors, candidates, or is there a vote somewhere in a secret room in Jekyll Island? Do people get together on a council in Zurich that we don't even know about?
They play spin the bottle, Matt. It's actually a pretty standard, straightforward executive search. The board of directors from the St. Louis Fed will be in charge of selecting the new president. They've already put together a subcommittee to do that, and that subcommittee will hire an executive search firm, which will put together the names and resumes of good candidates. Then the subcommittee will interview them, and they'll make a final choice. Now, when they make a choice, that choice goes to the Board of Governors, who can reject somebody. And that's happened a couple times in the past when before Pat Harker was selected as the Philadelphia Fed chairman, somebody that they had also chosen was rejected by the board. And it may be that's why it's taking so long for Kansas City to find somebody. They may have found somebody that the board didn't like. So at this point, it's up to the board of directors of the St. Louis Fed. And as we see with Kansas City, it can take a very long time, or they could promote somebody maybe from the inside in a very short period of time.
Just quickly, is this a voice that Jay Powell kind of reached out to, Jim Bullard, or no?
No, I don't think so. I mean, Jim was certainly a valuable contributor, but he wasn't a confidant of the chairman.
All right, so let's get to the markets, and we're going to get to the inflation data because it's a reason why we're seeing the markets. Jess, talk to us a little bit about the trade.
Well, especially just on the back of that PPI data for producer prices this morning coming in at the slowest pace in nearly 3 years. But I've talked to you and Matt a lot when it comes to the CPI-PPI spread that Gina Martin-Adams and her team at Bloomberg Intelligence follow very closely. So that actually turned positive for the first time back in December. So they actually got that call right because that was telling you that input costs, especially for businesses, were improving months ago, more than a half a year ago.
Tell Pepsi, because they're still raising prices.
Right, exactly. And then also that eventually filters in more toward consumer prices. And so the whole point of why Gina and her team monitors that is what it means for corporate margins and then how that eventually does support stock prices. So certain investors maybe that potentially looking at that gauge were already looking well ahead, 6 months, 12 months ahead at that. So that really tells you that most of the pain on the margin side might actually already be past at this point.
I'm just looking. I'm pretty sure that I can say when looking at the S&P that we haven't been this high since 420 last year.
So it's the highest level since April of last year. That is correct. But something I wanted to bring up too from a technical perspective, which may cause some problems here because I know Carol likes the technicals. Matt gets a little irritated at times, but going to bring it up anyway
in a nutshell.
because this is money is stacked at a lot of these levels. But Bill Maloney, our in-house technician here, he was looking at 45.05. So that's basically around the 76% retracement level if you're looking back to the January peak of last year to the October lows. And so that could tell you maybe in the near term, that could be a bit of a resistance there. Something else, Abigail Doolittle brought up what was happening with the dollar, right? So obviously it's off of those peaks from September of last year, and you see that helping support the equity market. But in the near term, it might be oversold when you're looking from an RSI perspective. So that's saying the coming weeks, also how that kind of transitions to when it comes to the earnings picture. That is something key to focus on whether or not that could be more of a nearer term type of headwind for stocks, obviously after this gangbuster first half.
We're seeing buying as we speak into the equity trade, so it just continues to go higher and higher. 45.12 on the S&P. Mike, just talked a little bit about the producer price print this morning. Also, we got weekly jobless. What do we need to know from your regard?
Well, the producer price index doesn't have a direct relationship with the consumer price index, but it shows that price pressures in terms of input costs for companies are starting to fall and fall significantly. So that should ease some pressures on margins. We're going to have questions about corporate earnings in the second quarter as the earnings season begins in earnest. But it may change some views down the road about earnings possibilities. And if companies can still protect their margins and not have to raise prices, that'll help bring consumer prices down. So in that sense, it's a bit of good news. It isn't going to affect what the Fed is thinking right now. Jobless claims, to a certain extent, because they're such a high-frequency number, are telling the Fed that it is still a tight labor market. We're not seeing the kind of layoffs you would expect in these situations. So the Fed is going to have to decide whether they think that means inflation ahead or whether that means soft landing ahead, because we're not seeing unemployment rise, but we are seeing inflation come down.
What do you make of the high delta between the headline number and the core number? Both on CPI yesterday, which was, I think, 2.8%, and today on PPI, which is 2.3%. What is it that's driving inflation higher, if not food and fuel?
Well, it's been stickier inflation things like the housing numbers. It's very hard for the government to come up with a good number that represents home ownership, because you don't buy a home that often. And also you want to include whatever your mortgage costs are. So they impute what the numbers are. And the same with healthcare in some areas, and the same with some of the travel costs. So there are reasons why there are items that take longer to rise in price and take longer to come down in price. The headline numbers are heavily influenced by food and energy, and that's why we've seen a much bigger drop there.
Mike, just quickly, 30 seconds. Can we get inflation down, or the Fed get inflation down to its 2% target with a tight labor market with wage pressures?
Yeah, I was asked that question this morning, and I think the answer is no. The Fed's going to struggle to get to 2% because inflation is just a little bit embedded in some of these areas. So then they have to decide whether they want to really push it and keep rates high for a long time to try to get it down to 2%, or whether they'll live with it for a while.
3's cool, I guess, for now, right?
I'm okay. I'm okay if prices come down for our consumers. Jess, in terms of the financial markets, is it cool for assets, stocks, valuations if we stay at 3%?
CPI, obviously everybody's talking about whether or not the Fed can get it down to that 2% target. But when I've been speaking
do we still
with
need
investors,
an asset, though, valuation reset if we stay at 3%?
Well, I think the big thing is more how tech earnings come through. So they're actually supposed to have earnings growth of about 16% compared to a broader index contraction of 8%. So if they can actually beat that, that might actually potentially bode well there. But obviously, a lot of it is driven on AI, and there's a lot of question marks still, unknowns about how that feeds into.
But it would support the market concentration that's been out there, right? Because that's where you've seen the move up in, right?
I mean, I don't know.
You should read my weekend story from last weekend about concentration in history in the S&P 500. Actually, bodes well.
And there's always been, I was reading a story by Vildana Hajrek and Jaron Whitney. They talked about that there's always been historically a market concentration.
There always has been. This isn't the first time.
Stocks,
and you can go by, and such extremes in the past haven't boded poorly for the equity market.
Which I thought was interesting.
Yeah.
More to come?
Yes.
On that. All right, guys, thank you so much. Michael McKee, continuing the hat tour. We so love it. Be well. Michael McKee, International Economics and Policy Correspondent, Bloomberg News, out there in Idaho. And, of course, Jess Metton, thank you. Deputy Team Leader for U.S. Equities at Bloomberg News. Check her out at Bloomberg.com.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We begin with a developing story for the first time in 6 decades. Hollywood writers and now actors are on strike at the same time. A new blow for hundreds of thousands of film and TV workers already idled by the entertainment industry's growing labor strife. Moments ago, the Screen Actors Guild, which represents some 160,000 performers, announced a walkout after failing to reach a new labor agreement with the Alliance of Motion Picture and Television Producers. That group represents studios including Disney and Netflix. The strike begins at midnight. Stocks are moving higher right now. Wall Street did get an extra dose of encouragement to bid up stocks after another inflation report reinforced bets that the Fed is approaching an interest rate peak. S&P up 38, now at 4510, a gain of about 0.9%. Dow Industrials up 66, up 0.2%. Nasdaq up 233, up by 1.6%. Nasdaq up 233, up 1.6%. We've got 10-year yield 3.75%, with the 2-year yielding 4.61%. Spot gold up $2.80 the ounce to $19.80, a gain there of 0.1%. West Texas Intermediate crude up 1.9%, $77.20 for a barrel of WTI. Delta Airlines profit is soaring as a rebound in international travel promises to keep planes packed through the crucial summer season and beyond. Delta lower now by 0.3%. Also out with earnings this morning, PepsiCo. It did raise its sales and earnings estimates after a strong quarter. PepsiCo up by 2.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So Matt and I have been talking about it. Matt Miller, Carol Master, along here on Bloomberg Business Week. ExxonMobil agreeing to buy Denbury for $4.9 billion, its biggest acquisition in 6 years. It's a deal that will give Exxon, which is, of course, a major integrated oil company, major player. It's going to give it the largest network of carbon dioxide pipelines in the U.S. Danbury's key asset. I guess they've got 1,300 miles. Yeah.
CO2 pipelines what got my attention today, because I was like, what are CO2 pipelines? We have pipelines that ship around CO2, so I started looking into it.
And
it turns out that they use that to pull more oil out of old wells, but also they can use these pipelines to carry CO2 around and put it back in the ground.
Yay. All right, so let's find out the significance of it. There's also some news on Shell looking for options to sell, I guess, its global renewable power operations. With more on all of this is our energy guru, Alex Steele. She's also Bloomberg TV and Commodities Edge anchor, and she's on the phone in New York City.
On the European close.
Yes,
From
indeed.
10 to 12, every weekday.
Alex.
On Bloomberg Television.
Love the promo.
Hello, hello. So tell us about the significance of this deal, Alex.
So basically, Exxon's buying these pipelines, like Matt was just saying, and this is really an Inflation Reduction Act play. So here's the deal. In the Inflation Reduction Act, there is a subsidy where if you're able to put CO2 in the ground, you get $85 a ton. And that comes in the form of a check, and then eventually it comes in the form of a tax credit. So there's a lot of money to be made in this, and that went a very long way in making the storage really viable, right? So this is what Exxon did. So they are working on a few projects on the Gulf Coast. They have 3 customers, CF Industries, Lind, as well as Nucor, that they promised they're going to put some of their CO2 back in the ground. And this is going to go a really long way in helping them do all of that. Net, that's the deal.
So let me bring in Kevin Crowley right now, senior U.S. oil reporter. Kevin, how serious is this putting CO2 back in the ground in terms of, fighting climate change? Oh, no, I can't hear Kevin.
You recognize this as...
Oh, now I can hear Kevin.
As a key...
Go ahead,
okay.
Kevin.
Can you...
Yes, we got you. Go ahead.
all the major bodies really recognise that carbon capture is a key climate change fighting technology, because there are certain sectors that are really impossible to decarbonise without carbon capture, such as cement, airlines at the moment, refineries, chemical plants, these type of things. They're always going to emit CO2, and carbon capture really is the only way to stop that CO2 being put into the atmosphere. However, carbon capture has had a very long history of failure, and Exxon is really hoping that this acquisition is going to help them get it right this time.
Well, and help us, I'm looking at ExxonMobil, right? This is a company with, Alex, $342 billion expected in revenues this coming year. It's a $422 billion market cap. So put this in perspective, this deal and their overall business.
Fair. I mean, it's a $6 billion deal. I mean, $5 billion. It's their biggest in 6 years. So that's one part of it. But I think it's about the future that counts. So they've already committed about $17 billion over the next 4 years to decarbonize their own stuff as well as other companies' stuff, if I just put it that way. Mm-hmm. So the idea is that they're going to be making a lot of money on this in the future. Like, is it a viable, super awesome business now? Probably not. I spoke to Dan Ammon, who runs their low carbon solutions business, on that, and he's like, we don't make a deal unless it's already profitable. How profitable it's going to be, I don't think anyone really knows that, because they're going to need the customers like CF Industries and Nucor to come in and sign these deals with them. What we do know is that this has the opportunity to be a lot more profitable than the deals like Shell and BP, who bet on renewables. Now they're like, oh God, what do I do? The returns aren't there. I got to get out of this.
And we're seeing that today in Shell. Mm-hmm. I wonder, Kevin, and I'll throw this one to you. ExxonMobil famously has board members from Engine Number One, an activist shareholder that hopefully is going to do good for the climate. Is this kind of deal, is this kind of movement, bear the hallmark of Engine Number One pushing ExxonMobil to be a more responsible kind of global citizen?
I think so. I think it's inconceivable that this would have happened before 2021, which is when those Engine Number One directors were elected onto the boards. And now Exxon has this low carbon solutions business, which is one of its three main divisions, alongside its big upstream and obviously refining and chemicals. So they are taking this now a lot more seriously than they were, even 3 years ago. So clearly they are having a big effect on the company's strategy. Now, it may not be as quick as what some environmentalists would like, but I think the hallmarks of Engine Number One are definitely here.
Help me out, guys, though. I mean, this carbon dioxide has to go somewhere, right? And if a pipe bursts, not a good thing, right? I mean, so, Kevin, there are dangers to this strategy.
Yes, definitely. I mean, the best thing for the environment is not to produce the carbon dioxide in the first place, and that's why a lot of environmentalists are actually anti-carbon capture, because it does perpetuate the life of the fossil fuels industry. But in the event that carbon is being produced, the industry says, well, it's much better to capture it and put it in the ground. But you're right, there are a lot of risks associated with that. The industry says that carbon can be sequestered in the ground for hundreds of thousands of years. Do we know that? We don't. Yeah. It may not work like that. Pipelines also can be quite dangerous. There was a big incident in earlier this year, I think, in Mississippi, where a carbon dioxide pipeline burst and was awful for the surrounding community. Lots of hospitalizations, etc. So this is certainly a strategy not without risk. And as I said, carbon capture hasn't had hasn't really worked for the last 20 years. So now Exxon is really making a push to really try and make it work this time.
It's got to be a valuable asset just because this is pipeline that is built. I mean, Alex, the regulatory environment here. It's not easy to build pipelines for anything.
No, and then that's one of the questions I asked Dan Ammon. I was like, Why was this better to buy than build? It would have cost probably more, or more importantly, taken a lot longer. I read this one great article or survey that said you're looking at anywhere from like 3 to 6 years to do anything, like whether it's natural gas, whether it's wind, any of it takes forever to get it done, which is one of the main hurdles in the energy transition. Like everyone knows secretly you're going to need to put shovels projects in the ground, but no one wants to be the first person to say that. So this kind of gives them a leg up. What is also interesting too, and I wonder, if Kevin has thoughts about this also, is what it means for their oil assets. There was lots of rumors circulating that Exxon was going to buy Pioneer Natural Resources. That would have been a straight up pure shale play. And I wonder if that puts it on the back burner now, or if they can, chew gum and tie their shoes all at the same time. But I wonder if it also sort of takes the focus away from that part of the business in terms of actually buying that growth too.
Kevin, what do you think?
I think Exxon can tie their shoes and chew gum. Certainly,
they can chew all the gum.
Certainly, this is yeah, exactly. There is no way that this compromises or is a trade-off at all with the oil and gas business. Exxon is 100% all in on oil and gas. Will be for many decades to come. If they are expanding their oil and gas production quite aggressively, actually, all over the world. There's Guyana's the key example, but there's also Permian. We actually had this week as well. That's sort of targeting final investment decision in Mozambique in 2025 or so. So this is complementary to oil and gas, and of course this is a company that made record profits last year, so it can afford to do both.
You guys are incredible. Thank you so much. Alex Steele, Commodities Edge anchor, Bloomberg Television. Of course, the European markets close on the phone in New York City. And Kevin Crowley, our thanks to you as well, senior U.S. oil reporter at Bloomberg News on Zoom from Houston. Interesting, right?
Yeah, fascinating.
And it gives them a pipeline.
It was one of the first stories I read this morning. Very cool stuff. Let's get a check right now on the world national news picture with Dan Schwartzman. He's here in the Bloomberg 1130 newsroom in New York. Dan?
Yeah, I got terrible news for everybody out there. It's official. Hollywood actors have now gone on strike. They've joined writers who have been on the picket line since May. This marks the first time since 1960 that both groups are striking at the exact same time. The Screen Actors Guild announcing the walkout after failing to reach terms on a new contract by the midnight deadline with the Alliance of Motion Picture and Television Producers. Movie and television production is now expected to grind to a halt with this strike. I don't know what I'm going to do on the weekends, my friends. U.S. officials say that Chinese state-linked hackers had been accessing email accounts at around 25 organizations, including Microsoft, as well as the U.S. State and Commerce departments. The hackers reached as deep as getting into the email account of Secretary of Commerce Gina Raimondo. Microsoft has attributed the hack to China, but the Chinese embassy in London called the accusation disinformation, while also saying, quote, the U.S. government was the world's biggest hacking empire and global cyber thief. White House spokesman John Kirby on what the government is doing to secure the systems.
We took it very, very seriously, and we took actions immediately after to try to mitigate the effects of it. We're obviously taking a fresh look at our systems and our cloud computing capabilities to make sure we can be more resilient in the future.
China routinely denies any involvement in hacking episodes. A federal jury finding the man responsible for killing 11 people during a shooting rampage at a Pittsburgh synagogue guilty. He's eligible for the death penalty based on the crimes committed. The decision came after 2.5 weeks of testimony that mainly centered on the motivations of the shooter, Robert Bowers. The jury is next going to determine if Bowers should be sentenced to death for what's considered the deadliest anti-Semitic attack in the country's history. This again occurring back in 2018. In really the deadliest attack that we know of. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long at Bloomberg. Best level of the day right now on the S&P at 45.13. Also, best level of the year. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Shaw. That's right. U.S. stocks with a bid today, with the NASDAQ leading the way higher. Dow's currently up 79 points. S&P's gained 41. Tops 4,500. Well, the NASDAQ is up 232 points, or 1.7%. The U.S. 10-year yield falls to 3.76%. Gold is up 3. Oil is climbing. And Bitcoin is rising by 3.3%. Among the main 11 S&P sectors, leaders were tech and telecom. Only energy was in the red. And leaders to the upside in the Dow, Cisco, Microsoft, and Salesforce, while Walgreens and Travelers led to the downside. After earnings, Progressive fell 12%. And regarding the Fed, St. Louis Fed President Bullard has stepped down. Wrapping things up, Viasat plunged as much as 36% after an issue with one of its satellites. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, Bill Maloney, we thank you. And to hear live breaking news over your Bloomberg, type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody. 18 minutes left in today's trading session. Matt Miller once again eating nerds or something.
I'm not eating nerds.
What are you eating?
It's a healthy nut mix with, look at this.
To be followed by nerds.
That's a dried banana there. It
love
doesn't
dried
get any healthier than dried banana
Are there
chips.
nerds around there anywhere?
Not here.
At your desk? Maybe. All right, let's get to it. We're watching the markets. Equities continue to march higher on this Thursday. A lot going on. Let's get to it, though, with Doug Sioka. So glad to have him back, CEO and partner at Kavar Capital Partners. They've got about $1 billion in assets under management. Back with us on Zoom from Leawood, Kansas. Doug, good to have you here. I'm assuming you're not eating any nerds. Having said...
Nah, I'm getting hungry, though.
For nerds or for... no, but let's talk about it. Hey, listen, let's ask about Jim Bullard. I don't know.
Yeah.
Is there a thing for you, an importance of Jim Bullard stepping down?
You know, I was happy to see it, actually, Carol. And I think just generally change is pretty positive. And I know technically there are, I guess, the term limit of 14 years, but it's a really long time. So I think having fresh perspective interwoven, even with more regularity, can't be bad. I also think, right, it's exceedingly difficult now to come up with something impactful and insightful to share with as often as these Fed governors and presidents are asked to speak. And I think sometimes there comes maybe a temptation to make grandiose statements or proclamations, even when there are none that are necessary. And I always felt like Bullard could not resist that temptation.
That was actually my takeaway as well when I first read the story and saw that he won't be he won't be agreeing to any more speaking engagements from today. I was like, phew. He also got into a little bit of trouble with that speaking engagements, right? Because he was getting paid for speaking engagements that were kind of private.
Yeah, I don't know the facts on that, Matt, but again, I know that with Powell as the president and elevating kind of communication, the public profile of these Fed presidents, voting or non, it to me was almost counterproductive, right? When you are making policy by consensus, and I get the SEP and I get the mysterious anonymous dot plotting, but when you come out then and have comments and commentary that are inconsistent with like the policy vote, then we got to wait for the minutes. I just feel like the rhetoric and kind of the court of public opinion, which monetary policy has been deployed over the last several years, I just have found it to be counterproductive. And again, I kind of felt like Jim Bullard was one of the lead, the lead baton twirlers in that whole circus.
Let's put that aside and look at these markets, because over 4,500 on the S&P, and we continue to, well, we're at session highs again here. up 1% after rallying every single day this week. What's good out there, Doug? I mean, why are we so bullish here?
Yeah, right now, obviously tech keeps running, and it's kind of a combination of three things. Number one, path of least resistance. Number two, FOMO. Number three, we're actually seeing like tangible amounts of retail money beginning to come into the market. And I think commonly people feel like there's a contrarian sell signal. Okay, here comes retail, time to get out. Maybe that's when retail is a little bit more fully invested, right? Retail creates kind of another wave of momentum in the direction kind of where the best opportunities have seemed to be identified. And momentum itself is a factor, right? I read something the other day I thought that was pretty fascinating, is that even when markets, right, with the expectation of identifying sort of oversold levels or overbought levels, even when the NASDAQ 100 historically has been 20% above its 200-day moving average, the 6 to 12-month return going forward is still about 20%. So I think maybe there's some of that that's playing itself out, but certainly the momentum is extremely strong right now. We'll see what happens with earnings next week, right? To see if that's going to be an additional tailwind or if that's going to be an impediment to continuation.
Have you been buying banks ahead of it?
We haven't been too aggressive, like in the financial side. One of the things, in spite of kind of the calming down on the psychological concern about the viability of some of these banks, we really are really concerned about like the ongoing profitability, particularly of the regional and smaller banks, right? You have lower loan demand just because the economy is generally slowing. Number two, you have higher expenses because it's difficult to make that interest margin when your cost of financing is going up just to be competitive with the prevailing money market rates. And number three, you're going to have more regulation. So it's difficult for us to ascertain where we are kind of in that profit cycle for the banks in general, Carol.
I was actually making a list of pros and cons for the banks, and I could only come up with cons. And the slowdown in deal making, higher deposit costs, flightier deposits, higher regulatory costs, too much headcount, drop in loan asset values. I mean, I just can't think of a pro.
Yeah, pro is going to be consolidation, Matt. Which maybe gets a little bit more on the speculative side of why you want to own one. Outside the operational value, maybe the book value and kind of the contributing value, the accretive capability to be folded into a large organization. I fear for like the smaller community bank, only because I feel what the Fed has done, inadvertently or otherwise, has made it a lot more difficult for them to survive independently.
And I guess some of it depends on the economic cycle too. Banks are so way down, right, because of all the regional banks.
But it seems like the regulators want a consolidation wave in banks, right? There's over 4,000. Yeah. They seem to be pushing for that. And ironically, that could be a good thing for the big banks because their investment bankers could have some work to do.
That's true. And they're looking for work to do right now. Obviously, if you read what Goldman has said in the last couple of quarters and even in kind of the quasi pre-announcement, the deal flow is lower. And I think multiples are contracting. Cost of capital is higher. Generally, global economic ambiguity is elevated. So you're not seeing a lot of deals that are just going to get rubber stamped and put through. They're going to require a whole lot of kind of heft in that whole banking lineup right now. So yeah, they could be to where corporate finance guys make an introduction to the M&A guys, they get a deal done, and then they make a bigger bank, and then 12 years from now, they deconstruct that bank and the bankers get paid again. So maybe that's where we really need to be focusing.
Balanced portfolio, it's back.
It's back. It's back because both sides of it, right, are making contributions, and we're spending a lot of time right now in kind of the structure of our fixed income portfolios. And there's no question that yield curve is going to normalize. So we've seen kind of a little bit of an attempt to do so just this week. And we're of the mind that it's going to be a disproportionate adjustment with the front end coming down versus the back end going much higher. And this whole, we have a long way to go, going back to the Fed rhetoric, it's a bit bizarre in my opinion, right? I think the Fed needs to continue to relax. I don't think they're going to stand pat in July. But we have these known lags of monetary policy that are taking hold. And any time, right, historically, when the Fed funds rate has gone above CPI, the forward outlook 12 months for the bond market is extraordinarily strong. I don't see why that's going to be any different this time. Right? I think the thing is, more than anything, just wrapping your brain around buying bonds in longer dates with shorter yields and money markets. But you have to understand, despite the conventional wisdom, capital appreciation will make up for the yield difference.
Doug Sioka, be well. He is CEO and partner at Kavar Capital Partners, joining us on Zoom from Leawood, Kansas. This is Bloomberg Business Week.
your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Federal Trade Commission is urging an appeals court to delay Microsoft's $69 billion takeover of Activision Blizzard, while the agency's challenge to the largest ever gaming deal is pending. Delta Airlines' profit is soaring as a rebound in international travel promises to keep planes packed right through the crucial summer travel season and beyond. George Ferguson covers the airline industry for Bloomberg Intelligence.
We need more pilots. Employees are definitely a problem right now, but I think longer term, the training of pilots, the bringing them into the industry, I think it's a challenge that's going to overhang for a number of years. We have a lot of retirements coming up. So I think the airlines really have to be thinking about that.
And we are seeing airline shares trade lower today. Delta down now by 0.5%. UAL, parent of United, down 0.5%. American Airlines Group lower by 0.7%. JetBlue is down now by 5.2%, while Southwest Airlines is down by 3.7%. So it is an update on Wall Street as we head toward the closing bell. One of the stocks that is moving higher after earnings, PepsiCo, it did raise its sales and earnings estimates once again after a strong quarter, suggesting consumers are still willing to pay higher prices for its beverages and snacks. PepsiCo shares are up right now by 2.5%. And those are some of the company stories we're following for you at this hour, and this is Bloomberg.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, just about 4.5 minutes left in today's trading session. Carol Masser along with Matthew Miller. We're going to get the market close in just a few minutes. We'll head over to our TV colleagues to talk about it.
I'm so excited.
Are you?
Yeah, I mean, look, we continue to rally today. No, I mean about the market close. So we continue this rally, and whether or not it's right, whether or not it's supported by the fundamentals, it's so much fun to see us hit new milestones. Now we're up over 4,500. Meanwhile, strategist targets for year end are still under 4,100.
Well, did you see, who was it that there's a story on the Bloomberg that talks about somebody saying, like, we're definitely going to be a record level on the S&P by the end of the year. I can't think.
Someone extremely bullish, right? That must be.
Goldman Sachs. There it is. John Flood, partner at Goldman Sachs. He says,
I was going to say Tom Lee.
Bar is exceptionally low for upcoming earnings season. I agree with that. And he sees the S&P rising to a record before year's end. And I was just looking at, was it 47 something? Is it the record on the S&P?
The record on the S&P, 47.96 and a half.
Not so far. So we're about
No, we're very close. We're 300 points from here.
Yeah.
You know?
Exactly.
I just think it's interesting to see us march up like this. Like, when I make a list of pros and cons, there's not that much on the cons side. I mean, on the pro side. I feel like there's so much interest rate hiking power in the pipeline that's ready to just crush this economy.
It's already there, though.
We have
and
a situation
lot of it, as we
where
heard yesterday, has worked its way through.
You don't have a lot of massive layoffs now. They kind of tapered off in January and came down, but you have no attrition. Nobody's quitting,
Well, yeah, I mean, the tight labor force is something that I think, does it enable the Fed to kind of keep raising rates, do what it needs to do?
Excess savings were in consumers' bank accounts, and I think it's pretty much gone. Credit card debt is going up. Car loan delinquencies are going up.
So what do you think, the second half?
It just seems like storm clouds are gathering, right? And yet, the market continues to rally.
Well, and again, like we've talked about this, we laugh about it. We're so managed with earnings, and the expectations keep coming down. And then, of course, they beat, and then everybody's like, yay, everything's great. And it's like, not so much. All right, everybody, just a few minutes left in the session. We're going to head over to Scarlett and Romaine. We're going to talk about the close. Beyond the Bell starts right now.
This Fed, a lot more coverage coming up as we move closer to these closing bells. Stick with us. We're going to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting it down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Carol Masser and Matt Miller. Welcome to our audiences across all of our Bloomberg properties. Carol Masser, looking at a NASDAQ 100 up 1.7% on the day, highest level going back to January, and S&P above 4,500, and if they close at that level, highest close going back to April of last year.
Matt was just talking about, I love these levels when we start taking out these kind of even levels, if you will. And I guess if you're a technician, you're saying maybe this is a significant move. Having said that, I'm looking at some of the big banks. Your Wells Fargo, your JP Morgan, your Citi, they're all higher ahead of tomorrow's earnings. So we'll see whether or not they deliver. There's a lot of pressure and stresses, as we talked about earlier. So I'm wondering if we're going to set up for some disappointment tomorrow.
As I was saying earlier, and I don't know if you heard this, Romaine, but we haven't closed this high since 420 of last year.
Oh, Matt.
It's pretty impressive.
Is there something significant about that day?
It's my husband's birthday. Is that what it is?
That's nice. Oh. It's Kriti Gupta's birthday as well.
Well, there you go. That's what it's about.
But yeah, we were up over 4,500 April 20th of last year, and then came crashing down pretty significantly, drop on that day, and we haven't made it back above 4,500 since then. It's interesting, as we expect another rate hike, it's going to be 550 basis points of hikes that the Fed has put into the pipeline that I just feel like are ready and waiting to weigh down this economy, and yet we continue to march higher ahead of earnings.
It'll be interesting to see. I mean, I was, you got a VIX now down about 13.5, the lowest levels we've seen there, not in quite some time. But then just the downdraft in the dollar too, and that seems to be a real indicator, I think, of some of the market sentiment right now. They really are making a bet, at least in the FX market, that the Fed is done. I mean, maybe you get another 25 or 50, but you're not going to get much more. Speaking of 420, Matt, Hostess ringing the bell there over at the NASDAQ market site. The NASDAQ up on the day by about 200 points. The NASDAQ composite going to finish the day higher by about 1.5%. The NASDAQ 100, I should point out, up 1.7%. That's the highest level going back to January of 2022. The S&P 500 up to this highest level since April of that year by about 0.8%. The Dow up 0.1%, and the Russell 2000 up about 0.9% on the day.
All right, so let's get to it. We dig a little bit deeper. S&P 500, most names, almost 350 to the upside today, 149, Matt, to the downside.
So taking a look at the groups in terms of who's winning and who's losing on the S&P 500, communication services are big gainers, as well as IT. And it really is those big, heavyweight, mega cap tech stocks that are pushing us higher. You also see consumer discretionary stocks. Remember, consumer discretionary includes Tesla, materials and real estate up. The only losers are energy and healthcare. Healthcare's done poorly. Yesterday, it was one of the very few groups down, and the day before that, when everybody was up, healthcare was unchanged.
All right, guys, to the individual gainers. Matt talks about some of those mega caps really providing a bunch of momentum in today's trade. Google among them, finishing pretty much just off its highs of the session, up about 4.7%. It was top in the S&P 500 and the NASDAQ 100 a little bit earlier in the session. And it did release its Bard chatbot. They did that to users in the EU and Brazil. Our Mandeep Singh of Bloomberg Intelligence covers Alphabet and said, noting that the company could show resilience in ad pricing and cloud ahead of second quarter earnings results, which are later on, I believe, this month. So I forget the exact date. But anyway, so that was definitely an outperformer. Amazon, an outperformer. High volume, up 2.7%. Reported record sales during its Prime Day sale, that two-day sale, compared to a year ago, up 6.1% from a year ago. Short, though, of the 9.5% growth estimate. That was according to Adobe, but nonetheless up 2.7%. TTD, that is the ticker for Trade Desk. It is higher in today's session, up almost 3% off its highs, though, of about a 7% gain earlier in the session. This on news, it's going to replace Activision Blizzard in the NASDAQ 100. And then MGM Resorts, I just wanted to point out, up about 4%, hitting a 52-week high. Barclays raising its price target to 62 from 60. Stock closing at $48.99 and change, maintaining its overweight rating. And yeah, that's it. That's my individual gainers.
Good job. Good job, Carol.
All right, let me take a look at the losers here. ExxonMobil, one of the big drags on the S&P 500 by points. Of course, the company making its biggest purchase in 6 years, paying almost $5 billion for Denbury in an all-stock deal. Progressive was the worst performer in the S&P 500, losing 13%, the biggest drop since 2000 after it reported a combined ratio, which is a profitability metric for insurers for last quarter that missed the average analyst estimate. It also sparked declines in other insurers like Allstate and Travelers as well. Fastenal losing 3.5% on the day after the industrial distributor reported sales and earnings that were in line with analyst estimates, but analysts called that report underwhelming. Probably because, not including today, the stock had climbed about 13% in the past 3 months. And Carnival Cruise Lines, I know, Carol, you keep a close eye on this one, off by 2.6%, a fairly bearish note from Shore Capital that questions the stock's valuation metrics.
All right, let's take a quick look in the yield space because it was actually
20% this year, though. Sorry for me.
Yeah, it was a wild day in the yield space, Carol Masser. We talk about that 13 basis point drop that we had yesterday on the 2-year yield. We had a similar move today here. So basically a 30-point shift down in the 2-year yield just over a 2-day stretch. If you remember, you go back to early May when we had something like a 34, 35 basis point drop over the course of 2 sessions. And that was all about also, of course, the Fed communication and what Jay Powell said and all the debate about pivot versus pause. So a little bit of a replay of that again here on the day. You can see the moves on the other end of the curve a little bit less extreme, and you put it all together and that leads to a bit of flattening in some of the key points in the yield curve. Your 210s right now at negative 86.
Yeah, I think the rates move has been really the most fascinating across asset classes. We've seen big moves in equities. We've seen big moves in FX. We've seen big moves in oil, right? Every day I continue to watch NYMEX crude march higher. And right now, by the way, it's trading for more than $77 a barrel. But it's been amazing to watch the 2-year come down from over 5 to whatever it was just now, 460 or something. And to watch the 3-year continue to, or 10-year continue to march down as well. You had at least less, well, what's the opposite of inversion? You had more curve flattening over the past couple of sessions.
You know, as much movement as there has been in equities, you talk about the big swings, the trajectory is one direction, right? It just goes up, up, and up. Whereas the swings and the yields, I mean, you talk about the 2-year above 5%, it was there back in February, March as well, and it has come way back down. So the swings and yields makes it so that you question, how do you value equities if you can't figure out how to value risk-free treasuries?
Yeah, no, that's actually a really good point. We talked about that with Jess Menton a little bit earlier in terms of, you know, what kind of valuation reset based on kind of where we settle with rates. And it is really hard, I think, for investors to do it. At this point, they're willing to take the risks in terms of the equity trade.
Well, when we talk about valuations, of course, then you have to talk about earnings. And we did have the earnings season start today. Overall, I guess it was relatively solid. You look at the earnings out of Pepsi, you look at the earnings out of Delta, Fastenal, and some of the other manufacturing names, not necessarily quite as good, but you know, if anyone's looking for a big drop-off here, at least in the 4 or 5 companies that reported of significance, you're not seeing it just yet.
No, we're looking obviously tomorrow. Not only have you got the big banks, but tomorrow you've got United Health coming out, which I think will be interesting, especially since the healthcare group on the S&P 500 has trailed every other group for the past 3 days.
Well, they have some levers to pull, all these different companies. Even if they are seeing slowing demand and slowing sales, they can reduce costs and fire workers and be able to preserve most of their profit margins. So that trickle-down effect into the economy will take time to suss out over the next couple of months.
Hey, speaking of the economy, we do get some economic data points. We've got University of Michigan. We're going to get sentiment. We're going to get inflation expectations. This is for July, so we'll see what's kind of remain in the psyche of consumers, which are, of course, as we know, so important to our economy.
Yeah, and I mean, but how divorced is that now? I think from some of the what we've seen, the price actions in the markets themselves. And I know there's always that debate about the markets aren't the economy and vice versa. Right. But, there's some point that all has to be reconciled. And I do want to go back just to the moves in FX, because, Matt, you're talking about sort of the outsized moves that we've seen in treasuries and why that matters and in commodities. But the idea that you're finally now starting to see these big moves in FX, I think that adds a much different dimension now to, I guess, whatever comes next. And you wonder how much of the rally that we've seen this week has also been because of that downdraft in the dollar.
You've seen 5 days in a row of the Bloomberg Dollar Index falling. So big lift for the euro, big lift for the yen. And if that continues, it's going to be very interesting to see how much money starts to follow that out of the U.S., right, into other places. EM is, yeah?
Are you following crypto, Matt?
I have been following crypto. Yeah. It doesn't move nearly as much as other assets. When I look at Bitcoin, for example, yesterday there was a story on the terminal about Bitcoin losing value, and it was only down 0.7%. In the days when I first started covering crypto, like 70% was a more likely move for any given day.
Yeah, you want action, follow treasuries, don't follow Bitcoin or crypto.
Yeah, definitely.
Big arrest today, though, and big fine from the FTC, right? $4.7 billion fine for Celsius, but they don't have to pay it.
It's Celsius, and then that Ripple judgment. What did you make of that, Matt?
I tend to stay away from Ripple for fear of getting flamed on social media.
Oh, okay.
Stay away from anything?
Okay, we'll talk
Ripple.
about that after the break.
All right, guys, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals. We will catch you. We'll be talking banks tomorrow. We'll catch you, our simulcast. Talk a little bit about the big banks, because at this point, less than 24 hours, Matt, less than, I don't know, I'm trying to think how many hours. We'll have those results. Let's do the math.
Until what? Until the bank earnings, you mean?
Yeah, JP Morgan, what's it, 7 a.m. tomorrow morning, 6:30?
Let me see. JP Morgan at 7 a.m., Wells Fargo at 7. We get BlackRock sometime before the market. We get State Street at 7:30
So about
a.m.
15 hours
Citigroup
from now.
at 8 a.m.
Max Reyes is sitting by like, come on, guys, just come to me. He's got a great story because we know that there's a lot of stresses on all of these big banks and the overall banking sector. Max Reyes is Bloomberg News regional banks and insurance reporter. He joins us on Zoom in New York City. Safe to say, Max, the expectations for the big banks, it's pretty low.
Yeah, I would say that the way I would think about this quarter is that banks don't have very far to fall. The way one person explained it to me is that the bar is pretty low, right? So you just have to make sure you don't let anyone down, and you should be doing okay.
I was looking at the problems that they face, though, and they are myriad. I think I can use that word. There's been a complete slowdown in M&A. You've got the assets on their balance sheet, the loans are worth less and less if they do want to mark them to market. They have too much head count. They have to pay more for deposits, and those deposits are flightier than ever before. So what are the pros for banks? What's going for them right now, other than low valuations?
Well, one thing is that you can only go up from here, but other than that, there's also the fact that consumer credit is still pretty positive. We're obviously seeing some of that return to pre-pandemic levels, but even with that, given how pristine credit has been for so long, even going back to what it was isn't a horrible transition, if that makes sense. And then overall, banks do have various levers to tug on. So we'll see what they end up doing. But it's the kind of thing where even if things don't look great, again, you can only go so low, and then you can only go up from there.
But net interest income, which is always a closely watched metric when it comes to the banks, Max, that's obviously been under pressure because of the big move up that we've seen in interest rates over the past year, courtesy of the Fed raising rates.
Exactly. And so what we're actually going to see is less so an increase in non-interest expense and more so a really drastic increase in interest expense, which essentially is how much banks are paying for stuff like deposits, their borrowing that funds their activities. What essentially we're seeing is that even though banks might see moderate or noisy but not super concerning expenses, they're going to see pretty harsh increases to what they're paying for the borrowing that funds all the wonderful stuff the bank can do, right? Lending, that sort of thing. Their bread and butter is just becoming more expensive because, to your point, what the rate environment looks like right now.
But why? Before this all happened, I would talk to bank CEOs and they would beg for rates to rise. And the idea is, even if you're paying a fair rate for deposits, say you're paying 4.5%, you're still charging 7.2% for a mortgage. That's a pretty fat margin. Why aren't they making it?
I would think about it as the Fed having moved too quickly for them to catch up, right? So, you just mentioned mortgages, which is a great example. If you originated a mortgage during the pandemic, right, in 2020 when rates were rock bottom at, I'm just going to throw out a number, 2%, right? You're probably kicking yourself right now, but also everything else you're originating hasn't repriced fast enough to catch up to your borrowing. So basically, the issue isn't that rates went up; it's that rates went up too quickly for banks to keep pace with them. If that makes sense.
It does make sense. I get it.
So in other words, they didn't benefit as much as they maybe could have in terms of the higher rates, right?
But they will at
Because
some
they will.
point, right, Max?
Lost out,
When does the bank's earnings catch up with that? You know, when does the slack get taken out? Or is it going to take a long time since nobody wants a 7.2% mortgage and everybody wants 4.5% interest on savings?
I think you might have answered your question right there. Essentially, the Fed still has a lot of wood to chop, right? We're still going to see where rate policy goes. You know, banks are sort of figuring out where they fit into this. But in the meantime, you know, the situation isn't getting better short term. It will at some point, but I don't think anyone can say when exactly we're going to turn that corner.
Hey, Max, is it fair to lump all of the big banks in one basket, if you will? I mean, you've got JP Morgan, Citi, Wells Fargo tomorrow, and then you've got Goldman and Morgan and B of A, right, next week. But is it, I mean, they're not all apples to apples.
Exactly. I would say that Goldman and Morgan Stanley are two to watch in terms of having more downside, just because they really count on trading, capital markets, investment banking, and those areas have taken a huge hit just because of where the economy is, right? Maybe less so trading, but definitely just the activity there has been worse. One question is whether or not pipelines, in terms of investment banking activity that's kind of been kicked further down the road, still forthcoming but hasn't happened yet, whether we might get, you know, a rosy update on that. But I would say that, you know, if you're doing investment banking, if you're doing capital markets, right now is not going to be a very fun time for you, unfortunately.
Unless you're a bank M&A guy and there's a wave of banks that consolidate, right? I mean, I think Matt Levine was writing about that last week. Is it going to happen, do you think, Max? Do regulators want to see bank consolidation? We've been asking everybody. I asked Betsy Duke this morning. We asked Elizabeth Warren yesterday. And the concern is, of course, that it hurts community banks, and we need them to understand us, you know?
Yeah, regulators do. Regulators, I think, have signaled that they're for it. But to your point, folks like Elizabeth Warren, you know, lawmakers have really been opposed to it. So the question becomes, what point do we get clarity from regulators as to whether or not deals will be able to go forward, and what will that look like? You know, talking about bank deals, TD First Horizon, I think, really put kind of a chill on the market just because that transaction ended up being sidelined. You know, there's a question as to whether or not it was because of regulation, question as to whether or not it was due to economics, just given how much ground First Horizon stock had given up, right? But that is all to say, I don't really think anyone has a clear answer. When I speak to folks, when I ask them the same question, are we going to see a lot of deals? Are we going to say no deals? I think they have the same kind of wishy-washy. Well, on the one hand, it would make sense to see consolidation, but on the other hand, that doesn't seem to be what the vibe in Washington, D.C. is right now. And that'll kind of determine what we end up seeing in terms of that activity.
Listen, you do cover the regional banks. I mean, what are you anticipating for the earnings season for them? Is there what are the banks that you're keeping on your radar? Is it the usual suspects?
I would say usual suspects. I would also say that in terms of the regional banks, it's all going to be about deposits, essentially how much they're paying for them, what the mix looks like in terms of sticky deposits versus less sticky ones, interest-bearing versus non-interest-bearing. Essentially, the key question heading into this quarter is how expensive is your activity going to be? How are you funding your lending and all of that with what you're doing? In terms of usual suspects, I would say it's all the folks who have been getting beaten up in the stock market for one reason or another. PacWest has had to sell a lot of assets, to shrink down its balance sheet, get things back to normal. There are questions about what all of this has meant for First Horizons, which again saw that deal that was terminated. So essentially, if you had problems last quarter, or if the street thought you had problems last quarter, you're going to be someone that we're keeping an eye on, because that's how this works.
And then there's the capital requirements, what we hear from the big banks. Yes. Like, we'll be keeping a watch on that as well, right? Because we certainly expect something after.
That's another one in the cons column, by the way. When I made my pros and cons list.
There's a lot of cons. It's hard to
They already have too many people working at banks, but they need more for their regulatory compliance department.
Yeah, but then I feel like we get to the end of the year, it's like, it's another record year for the big banks. I don't know. We'll see what happens. Max Reyes, thank you so much for this.
sarcastic hatred for them that a lot of people seem to have.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 closing back above 4,500. NASDAQ 100 index today advancing 1.7%. NASDAQ, the composite index, up 219 points, up 1.6%. But the S&P high for the year now up 37 points today with a gain of just about 0.9%. The Dow up 47 points, up 0.1%. Wall Street got an extra dose of encouragement to bid up stocks after the PPI report reinforced bets that the Fed is approaching an interest rate peak. 10-year yield 3.76% with the 2-year yielding 4.62%. Spot gold up $2.50 the ounce to $19.59, up by 0.1%. West Texas Intermediate crude rallied 2% today, now with a $77 handle, $77.30 on WTI, up today by $1.53 the barrel. Bitcoin up 4.1%, 31,602 now on Bitcoin. After earnings, Delta shares down 0.5%. After earnings, PepsiCo up 2.4%. Big banks start reporting tomorrow morning. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser along with Matthew Miller live in our Interactive Brokers studio. Matt, of course, in for Tim. I don't know if you've seen, Matt, I was looking at some statistics getting ready for this segment. And so we know post-pandemic, people were isolated, they were bored. A lot of people turned to illegal drugs. And
That's what I do when I'm bored.
Stop. The increase in fatalities was fastest from 2019 to 2021 as deaths from overdoses rose in general. Opioid overdoses took the lives of 80,000 Americans in 2021. That's the last year with official final numbers. And then we had, of course, the reckoning, a big settlement. So companies like Purdue, McKesson, J&J, CVS, Walmart, Walgreens, a lot of them, all part of a more than $50 billion settlement of opioid claims. So I don't know. Do you know exactly what's happening with that money?
It's interesting. I don't know about the money, but I spent, as you know, the pandemic in Germany.
You did.
And had some skiing accidents and broken bones while I was there, you know.
And you took
they don't prescribe opioids, essentially. I mean, they can, obviously, in terrible cases, but by and large, the most powerful drug you're getting for pain is ibuprofen. And as a result, they don't have any kind of problem with opioids.
All right. Well, maybe that's a deeper subject or deeper conversation.
I mean, that's the end of that conversation. That's how long it lasts.
All right. Well, let's see what Sarah Whaley has to say, because she is program manager of the Bloomberg Overdose Prevention Initiative at the Johns Hopkins Bloomberg School of Public Health, as you know, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. She's on Zoom in Baltimore. Sarah, I feel like you bring up the subject of opioids, and Matt makes a really good point. There's a lot to discuss.
It's a very American problem.
Well, and I agree. I just had a family member who had some surgery, and they just kind of threw opioids.
Still?
Yes.
That is
indeed.
nuts.
So where are we in the opioid crisis? Can we start there?
Yeah, so it's not a great topic to start off with because it's unfortunate. The opioid crisis continues to surge across the country. Like you mentioned, the numbers in 2021 are super high. They're 4 times higher than they were in the late 90s when OxyContin hit the market. And that is because we're in this era where the main cause of overdose deaths are synthetic opioids like fentanyl. And illicitly manufactured fentanyl is more potent than heroin and OxyContin, and it's unfortunately what we are finding in most street drugs across the country.
Why do people, I mean, I understand how people get hooked on oxys and Vicodins and Percocets. Fentanyl, everybody knows, is deadly. So why does anyone take fentanyl?
So when you have a substance use disorder, when you're addicted to opioids, there are cravings physiologically within your body, and there are drug-seeking behaviors. And so even though you may know the risk of purchasing drugs on the street, you have these cravings, and so you do it anyway.
Why are people, to Matt's point, in Germany, you wouldn't get opioids. Why are we still
prescribing them like that
and giving them out if we know that they're dangerous?
Yeah, so I think this all goes back to the lawsuits that you were talking about and Purdue Pharma. And so they're the pharmaceutical manufacturer of the drug OxyContin. And that drug was prescribed, overprescribed in our country for quite some time. And that's why these cases are coming through our court system right now, is because of the role that these companies have played in supplying pain pills in our communities.
It just doesn't make sense that, I mean, Carol, your family member had surgery, recently?
Mm-hmm.
So they're still doing it. I mean, do doctors just take a while to get on the same page as, everyone else? Are the doctors are they somehow paid? Do they get perks for prescribing these drugs? Do patients just demand them? I mean, why don't they just stop?
So I think it's a combination of a lot of things. Regulations in how we prescribe opioids have changed. in response to kind of what happened in the late 90s with OxyContin. I think I am not a medical provider, so I don't want to speak for them, but I do think there is still some utility in them. So there is fentanyl is used for patients who are experiencing a lot of pain from like cancer and other procedures. So there is utility in these pain pills, but they were widely overprescribed for some time.
Are they not anymore? Do we know that for a fact?
Things have changed. The number of pills that are going out has decreased immensely.
So what do we do if you've got someone who's addicted and isn't able to just stop using, which I would think that's what you'd want to do, right? Just stop. But if somebody says they can't for whatever reason, they love opioids too much, what do you do to get them off? Is there some kind of methadone, Suboxone treatment that actually works?
Yeah, so there's lots of avenues and interventions, and the money coming down from these opioid settlements can be used or should be used towards these opioid abatement programs, which are programs and interventions to treat, prevent, and reduce opioid misuse and the harms associated with this misuse. And they can be used on programs, for example, overdose reversal medication. So we often hear about naloxone going to first responders, but naloxone should be out in the community for people who are at risk of overdosing. So if they do take an opioid and they overdose, someone who is near them can give them naloxone and save their life. You mentioned methadone, so these dollars can also be used to increase access to medications for the treatment of opioid use disorder. We have 3 of those medications that are approved by the FDA: methadone, buprenorphine, and naltrexone. And while these are very effective treatments, they are currently pretty underutilized across the country. So in thinking about how states want to spend their settlement money, they could use that money to invest in increasing access to these medications. And then the other one I just want to quickly mention is harm reduction services. So harm reduction is a broad term used to describe a spectrum of services to reduce the harms associated with drug use. Like you said, it's hard to stop using opioids. So harm reduction programs offer safer drug use supplies like sterile syringes, but also an array of other services like medical supports, behavioral health, and other social services. And these harm reduction programs are often the first access point to vulnerable populations. And the relationships that are built by the staff at these programs can really help to facilitate entry into other services and ultimately recovery.
Sarah, for someone who has studied this situation and this epidemic, I mean, what do you think is the most effective thing we can do to actually really make a difference and put an end to this? So that I'm not talking about an opioid crisis, or Matt isn't, or you aren't in 2 years from now, 3 years from now, 5 years from now.
I mean, I think a big one is the stigma that we have and the lack of understanding